The economic weakness in the United States is more than a soft patch. Growth will remain anemic for quite a while, and the equity markets will stay in a risk-averse mode. That is the call from veteran and well-known economic forecaster Nouriel Roubini. What's behind the prediction? We go straight to the source and talk to Nouriel right now. In a CNBC exclusive, Nouriel Roubini is chairman and co-founder of Roubini Global Economics. Nouriel, it's always nice to have you on the program.
Pleasure being with you, Maria.
So you just heard Gene Sperling on the air talking about where we are in the economy and whether or not we are going to come to agreement in terms of the debt ceiling. You think the economy here in the U.S. needs more stimulus to avoid what you've called a fiscal train wreck?
Well, what I've been saying is that we're going to have a massive fiscal drag next year because state and local governments are cutting spending. Federal government's cutting spending. We're going to have a phase out of transfer payments, payroll tax, unemployment benefits. You add it up, it's about $200 billion of a fiscal drag next year alone. It's 1.5% of GDP. That's going to imply even weaker growth in an economy as a weaker growth. I'm in favor of fiscal austerity, but you have to not front load it. You have to commit to a medium-term plan where you're going to cut spending, raise taxes. In the short run, the economy is weak. You should avoid a fiscal drag and maybe have even a fiscal stimulus.
Now, you've heard, of course, these predictions from some other economists that say we're going to have a second-half snapback. The stabilization will happen in Japan. We'll have oil prices move lower. And that's basically their opinion of what snaps things back in the second half. How likely is a snapback in the second half, in your view?
Well, the second half is going to be slightly better than the first half, only because the first half was awful. Already a growth recession with growth below 2%. But the optimists say we're going to have 3.5% to 4% growth in the second half of the year. We're not at this growth rate even in the recovery. So I can see growth being slightly above 2% for an average of a year of 2.4. But that means that growth is still below potential. Unemployment remains high. Housing is double dipping. And you have the fiscal drag at the state and local government and the federal level. And now the monetary stimulus is going away as QE2 is going to be over, and we're not going to have QE3 for a while.
Do you think, and I guess, correct me if I'm wrong, but the corporate story, earnings, have really been the best part of this economic recovery, correct?
Yeah.
Do you think we're going to see the earnings story, this great corporate picture that has been so strong, get impacted by this slow patch?
I think eventually we will for a number of factors. First of all, economic growth this week implies top-line revenue is going to grow more slowly. Secondly, input costs are rising because of high commodity prices, but the ability of the corporate sector to transfer the input cost increase to retail prices is constrained by weak consumers and weak pricing power. Productivity growth is slowing down while wage growth is now above productive growth. So unit labor costs are going to be rising, and some job creation is going to imply operational costs are going to go higher. So margins have been very high. P ratios have been high. There could be a correction.
All right. So we could see an impact to the best part of the economic recovery. Let's talk about this perfect storm that it feels like we've got going on. We've got threats from all around the world that China will ultimately slow down. Europe is in the midst of its own, issues in terms of the debt crisis. How significant are these things to the growth of the United States? And what's your take on China right now?
Well, I think that my prediction for a perfect storm is not this year or next year, but 2013, because everybody's kicking the can down the road. We're going to have a problem in the U.S. after the election if we don't resolve our fiscal problem. China is overheating and has fixed investment at 50% of GDP. Eventually, it's going to have a hard landing. The Europeans are pushing their problems, but Greece, Ireland, Portugal need to restructure their debts. They're insolvent, and that's going to be done in 2013. Japan is going to have a short-term stimulus. It's going to slack again in a year from now. So I see every economy in the world trying to push the problems to the future. We start with private debt, public debt, supranational debt. We're kicking the can down the road, and eventually all these are going to come to a head in 2013.
And China, of course, has been the locomotive for global growth. If we see a significant slowdown in China, what kind of reverberations does that have around the world? Are you expecting China to have a hard landing?
Well, not this year or next year, but as I said, no country in the world can be so productive. You take half of your GDP every year, you invest in new capital stock, you're not going to have two problems down the line. One, overcapacity to a massive NPL problem in your banking system. And if China is going to have a hard landing, and for China, hard landing means growing towards 5-6% as opposed to 9%, that implies lower commodities, lower exports from Europe to China, weaker global economic growth, and the situation in which all advanced economies are already having weak economic growth, US, Europe, Japan, and other advanced economies.
What are you expecting out of the jobs report on Friday? And do you think this scenario that you are laying out with this perfect storm around the world, and I get it, because I'm looking at what happened to Portugal today getting downgraded and looking what's happening in the Eurozone and the Asian economies slowing down. The jobs number on Friday, what are you expecting, and is that priced into the market?
Well, I would say there is going to be some job creation, but it's going to be weak. And for the next few months, we're going to see job creation close enough, but not much higher than the increase in the labor force. That means that unemployment rate officially is 9%, including discouraged workers and partially employed workers is 16%. Labor force participation rate is now at the lowest level in the last 30 years. And if we don't have enough job creation, there's not enough labor income, and therefore there's not enough consumption. Consumer confidence is going to be depressed, and therefore the recovery is going to remain weak.
Is that priced into the market?
No, I think that the markets are expecting now a robust recovery in the second half of the year. I think the recovery is going to disappoint on the downside.
Smooth sailing is what the expectations are, and the expectations of a second half snapback. Nouriel, always great to have you on the program.
Great being with you.
Thank you so much. Nouriel Roubini joining